This week in Canadian real estate, we saw GDP numbers fall, which ultimately is shifting the predictions as to what size rate cut we're going to see in December. Consumer insolvencies are increasing back to pre-pandemic levels, but meanwhile, Canadians are also saving near all-time record rates. We have updates on where you can expect mortgages to go in 2025. And lastly, a preview into the November 2025 Vancouver real estate data, including how much prices rose that month. Let's get started. Okay, GDP is first. In the third quarter of 2024, Canada's economy grew by 1% year over year, according to StatsCan, with GDP expanding just 0.1% month over month in September. On a per capita basis, though, GDP actually fell 0.4%, marking the seventh consecutive quarter decline. While the quarterly numbers were in line with economists' expectations, the September growth was weaker than anticipated, with analysts forecasting a 0.3% increase. The economic growth that was experienced, it was supported by gains in real estate, retail, trade, and transportation, but it was offset with declines in construction, mining, and the energy sectors. For the fourth quarter, early data is also looking quite weak, and as a result, the odds of a 50 basis point cut in December have increased. Overnight swap traders are pricing in about a 33% chance of that 50 bip cut, up from 25% previously. At this point, though, I believe 0.25% is what we should expect, and our colleague Doug Porter, the chief economist at the Bank of Montreal, also echoes that he believes 0.25% cut is what we will see in December. Especially, of course, these predictions on the back of that recently revised GDP data from 3 years, where they found a full year's worth of GDP and pushed up 2021 to 2023 quite dramatically. Here's the kicker about the recent GDP print. Is this a function of people spending less because they simply don't have the money? Or is there another factor at play? Well, consider this. The household savings rate has just hit a 3-year peak at 7.1% in this third quarter. Disposable income increased at nearly double the rate of spending. This means that people are putting money in the bank instead of buying stuff. The overall feeling of doom and gloom or doubt or just plain uncertainty that many are feeling right now has ultimately shifted their buying habits and morphed them into savings habits. Canadians are all too familiar with rainy day scenarios as of late, as the last few years, and ultimately they have turned to saving over spending to prepare for this. A prudent idea, ultimately, as the next few years look to be anything but potentially smooth sailing.
Yeah, it really reflects the confidence in the marketplace and maybe confidence in public policy. And there's a whole lot of reasons why I think people are saving, and it's usually a hedge that they don't think things are going to go well. You know, much like we saw in the pandemic, it was a lot of uncertainty, and we're, backs are up against the wall here with some levels of uncertainty, both down south, but also in terms of our own. Going into 2025 is going to be an election year as well for us. So it'll be very interesting to see how that actually takes place. Let's have a look here at personal debt. This is pretty interesting to see that Canadians, like Dan kind of mentioned here, are saving at almost an all-time high. While they're also experiencing debt levels that are also at an all-time high. Credit card balances, as an example, grew at 9.7% year over year, and September reaching a new high of $110 billion in credit card balances. Consumer insolvencies were up 8.8% year over year and 18.4% in Ontario. And Ontario is the biggest population center, so that doesn't surprise me, but nevertheless, it's quite a bit higher. To give you guys some perspective, these numbers have now climbed back to pre-pandemic levels. And while that's maybe not necessarily too alarming today, the trend is what's alarming, because it appears like the rate of growth is continuing. And if so, we could enter the GFC level insolvencies within 2025. But I guess to some degree, some people are starting to feel some relief if they are in a variable rate mortgage, right? So some of those mortgage payments have come down. The payment required to purchase a typical home has dropped a modest $10 a month in October. So not a huge change, but still a change. It's now down 20% from the peak, which is good. But let's be honest. This is minor relief in a time when, people are realizing that their payments have gone up 90% from 2021. So, let's not focus too much on that. We need to focus more on the fact that where the payments have gone in this time period. The monthly mortgage payments to buy a typical home in Canada are now at $2,975 a month, effectively $3,000 a month. And that's compared to $1,600 back in 2021. Some staggering changes in our economy right now.
So to expand on mortgages, access to credit is one of the largest drivers of real estate sales volumes there are, right? Especially the cheaper that credit becomes. When interest rates hit a record low in 2021, real estate sales volumes hit a record high. As rates started to then increase, the sales volumes decreased. In 2024, rates peaked for our current cycle, with variable hitting as high as around 6.2 and fixed rate around 5.9. Today, variable's down to around 4.9 with fixed at 4.4. But after dropping for a few months, both rates have been relatively steady for the past few weeks. As of today, the markets are pricing in that 90% chance of a 25-point rate cut on December 11th, and of course that 33% chance of a 50-bip cut. And still, right now, there is a projected bottoming of the Bank of Canada overnight rates of 3% right now during the duration of 2025 from April onwards. Now, people have bought homes back when interest rates were 18%. People have bought homes when they were 0.25%, and people have bought at every interest rate in between. Rates are guaranteed to fluctuate while you own a home, right? If we go back 35 years, for example, the longest that the overnight Bank of Canada interest rate has ever stayed the same was 4 years. September 2010 to December 2014. 4 years, it stayed at 1%. Well, it's actually quite impressive, considering we haven't seen a stable rate for even 2 years at any point before or after that. So 2 years is kind of the extreme of what you can expect an overnight rate to stay stable. Now, we are obviously very aware of how many factors contribute to what the interest rate is, and of course what contributes to interest rate forecasts. So we wanted to share a few economic shifts that are taking place right now that are going to potentially push rates lower than that currently projected 3% rate in 2025.
Yeah, and I think to echo that, the first one I think that we've all become recently very aware of are Trump's tariffs. When we spoke initially about it, we were projecting somewhere between 10 and 20%. 20% being the high side when he takes power. But as we all know now, or you're going to find out that, the tariffs will in fact be at 25%. That's at the very least what he has said. Now, that size tariff would estimate to have a 2 to 3% negative impact on our overall GDP, and that would push us well into a recession. And ultimately, the way the Bank of Canada would react to that would be to further lower interest rates to create more stimulation in the economy. And the currency markets reacted to this news as well, and the Canadian dollar dropped to a stunning 5-year low against the US dollar. And now look, we all know Trump can bark louder than he bites. He's certainly a bit of a saber rattler in that respect. So there's a good chance that these tariffs, they either won't see the light of day or they will be significantly reduced. There will be a negotiation. And in my opinion, he's starting high, right? So he's putting that out there. Nevertheless, it's not going to be zero. It's going to be something. So let's take, for example, the fact he's included oil in this conversation. There's just not really kind of any way that Trump would add a 25% tariff to importing oil into his own country. But that doesn't make a whole lot of sense. And oil is incredibly important to that economy running smoothly and creating stable prices. So I think that's a bit of a touchy subject. And whatever the amount is and whatever the products end up falling into the tariff category, either way, it's going to cause the Canadian government to struggle. And where lower rates may be required to keep it afloat at the expense, in my opinion, of the Canadian dollar. We could see further Canadian dollar depreciation as a result of this. And, part of me also thinks that, maybe this is a bit of a way of Trump influencing Canadian politics at a time going into 2025 as well.
So another reason the Bank of Canada may be pressured to push rates lower than 3% in 2025 is that inflation, essentially their key mandate, appears to be well under control. The shelter component is still contributing to over half of the total print. We know rental rates are dropping, and with ample new rental units coming to market over the next 2 years, coinciding at the same time with population rates projected to slow dramatically, we'll continue to see the shelter component have less weight within that CPI basket. If you were to remove it entirely today, just for reference, inflation would be at 0.9%. Obviously a number where the Bank of Canada would have to stimulate strongly to get it up. They don't want it to be too low either. So watch inflation closely over the next 12 months, as it will obviously bounce up and down, but with a downward trend over the next 12 months, how low will it go before the BOC has to go lower than 3%?
It's interesting too. We were talking about rental rates. This morning, I was having a conversation with Cole on our team, and he was talking about one of his clients who has recently purchased a new property for themselves. And instead of selling their property, they've decided to rent it. This particular property is, from what I'm told, it's nothing too special. It's a ground floor, 1-bedroom walk up that's south facing in South Granville. And he rented it yesterday for $3,100 a month, which blew my mind. So while we are seeing overall rental rates coming down in certain pockets of Vancouver and certain pockets, those numbers will stay relatively strong too. So just a boots on the ground experience there that we're seeing. But let's start with the business confidence index here, because this is very important. This metric has been dropping since 2021 and is in line with the global financial crisis levels. Businesses across the country are closing at an alarming rate. We just saw the highest number of businesses close since the shutdown of Q2 in 2020. That was a time when they were also forced to shut down, right? Now they're shutting down because they can't even stay open. They can't afford to stay open. And what's worse is Canada's small business delinquency index just hit a new all-time high. Pre-pandemic rate was 0.35%, and it is now at a staggering 1.5%. That is a 4x growth in a troubling way. Do note that the US, though, is rising as well, but it's just not nearly as ferocious, right? They are sitting at 0.7% today, so about half of where we are. The monthly business insolvency rate rose 8.3% month over month in September and is up 11.5% year over year. Ontario is feeling this the most, with filings up 26% year over year. And they are 300% higher than where they were in 2021. This is a huge problem. This is what drives our economy: small business, middle-class incomes. This needs to be protected, and it is being sacrificed. Reality is that Ontario would also feel the most pain from the Trump tariffs, meaning things could potentially get a lot worse in that province, comparatively speaking, to the rest of Canada for the next few years.
Yeah, Ontario's really seeing the brunt of it right now, both in real estate and its economy and its delinquencies and its insolvencies. And their condo issue is definitely in the forefront lately, because the plight essentially of the Toronto condo is it's far from over. And as a matter of fact, it's kind of getting worse right now. It's not kind of, it is. Condo sales in the greater Toronto area were down 91% compared to decade averages just last month. While condo starts in the area have been lowering pretty dramatically as well, they have a long way to go to catch up to how low these sales are. At some point in 2025, condo starts there will hit 20-year lows. 20-year lows already. We're already seeing the new starts number start to drop nationally after peaking last year as well. But the rate at which this drops further looks to be, well, pretty dramatic going into 2025. And of course, with housing largely being the economy in Canada, you can expect the Bank of Canada to feel pressure to lower rates to quote unquote save Toronto and the country's real estate market. We know good old Trudeau has mentioned that he wants housing to retain its pricing, and then the BOC is kind of unspokenly hinting at this as well. So keep an eye on that, right? The lowering of real estate prices, while not as dramatic here in Vancouver, we're down, almost 8% from the peak, but Toronto is more like 18%. It's going to start getting pretty loud there. And if that cohort of the marketplace gets loud enough, good chance that you're going to see the Bank of Canada want to try and help them out as much as possible. So look for further stimulus from our government as well when it comes to developers and condo sellers in Toronto. Now, lastly, quick insight into what's happening with Vancouver real estate in the month of November. Remember last month, October, we saw like a notable spike in sales. Well, did that carry over, or was it a 1 month trend? Well, the answer is we've got 2 months in a row with elevated sales volumes. November will end the month around 29% more sales than 2023, bringing us up to around long-term averages, right? We're spiking, but we're not like high, right? We're just spiking up into normal numbers, meaning that obviously we're off of a low baseline. New listings, on the other hand, only look to have increased about 10%. But prices, interestingly, prices are on the rise as well. Median prices are going to wash out this month, increasing for the second month in a row, but only up about $5,000. Average prices, on the other hand, notable increase of about $34,000. We will, of course, bring you the full November data next week, but want to give you a bit of a preview into what to expect ahead of anybody else. Ryan, final words on this week's episode?
We're really starting to see the decisions that were made in 2021 and 2020, how long inflation was left to rise, how long bank took to kick in and try and curb this, and all of those either decisions or the neglect of making decisions, we're now evidently paying the piper for it and have been over the last little while. I do like to think I'm an eternal optimist, so I do think that 2025 people are going to continue to move into the real estate market as interest rates continue to drop, and so long as supply remains where it's currently at, I think it'll be a more balanced approach to 2025. But generally speaking, we're quite a ways away from this country actually performing at levels that we've seen it can do in the past. I'm just not convinced that we're going to see any kind of huge economic push in 2025. Again, really depends a lot on how the elections go here in Canada. So we'll see.
Lots and lots of moving pieces, as always, within the real estate landscape in Canada. Thank you, as always, for tuning in and watching. We will have all the November data for you next week. And for now, have a great weekend. We'll see you then. Thanks.